Hello everybody, welcome to another FreeFX video. Today I'm going to talk about market cycles, and for that I'm going to go to a chart here. And this particular video is really just trying to introduce a concept that I saw on my training for level 1 CMT. This is the book, and I've showed you this on my video about learning the CMT module. This is about market cycles, and it's about halfway through the book. So essentially market cycles are made of waves. Think of sine waves, and they have periods and an amplitude. The period is sort of between troughs from one body to the other, and the amplitude is essentially the height. Okay, and then you have different kind of parameters you think about, and also something called harmonics. So if you know anything about music, you basically got harmonics, which is a sound, and then if you take something like a string, you've got if you play the sound halfway up the string, you get the octave above, and that's basically a wave half the size of the original wave. Do half again, and so on. Same in financial markets, you have cycles, and these cycles basically are made of these waves. And so what you have to think about is, do these waves come back? Are they fixed? And the smaller waves, how do they relate to the big waves, etc.? So let's go into that and have a look at. It's a new concept, as I said. I'm just really starting on this journey of the CMT, and so applying this to something like this might be interesting. This is the US dollar index, which I'm trading at the moment, and you can see that there is an actual cycle that I put in. Now this cycle is an 8-year cycle. If you look at one of these troughs, that's 97 plus 8 is 05. This goes back to the 80s essentially, all the way to the present day and beyond. So I thought this might be a really good place to show you how these cycles might actually fit into price. The way I've kind of organized this is to take this particular peak in 01, September of 19 years ago, and fit the curve here at the top, and that created a nice kind of retrofit of the cycle. Now if I were doing that at the time, I might have done it differently. I might have used a different kind of setup. I didn't know that this price was coming, so for example, if I'd been doing that at the time, I might have put this in a different position. For example, I might have put it like here, for example, expecting price, you know, to come up and then stay around these levels at 80 basically. But then it actually came down lower than that. We got to 71. So if I'd been doing this cycle analysis back then, I would have expected price to stay within these. But as you can see, and what the CMT volume says, these cycles repeat for say a few months, and sometimes they repeat for about I think it's 6 to 12 iterations, and then they kind of come out of phase and they disappear. So if you can come in down from the 80s, it kind of fits this curve, this bell curve, the sine wave, and then it rises again and follows the curve again, and then at this point it comes out completely, it kind of destroys the cycle, and it doesn't really fit anymore. So you almost have to delete it from this point on, or shift it, and then start thinking about that. So that's one problem with that. So periodicity, it's a repetition of the cycle, but you got something called variation. So variation of the cycle is obviously not meant to be forever. So if we shifted it from there, so that instead of having this particular area on the right hand side of that, we had it so that it fitted it at the top there, like this. Okay. Now we've got, essentially what we've got is a 10, these are little boxes, I call them boxes. We've got this sort of amplitude covering 10 boxes, and that takes us down to the bottom price that we've had. So this is more reflective of what happened in price after that period, from sort of 1986 or 1985 to 2002 or something. What happens after is that the price comes down further. So now we're taking this new low and making that as a basis of fitting what happened before. We're basically got 3 areas that I'll show you about as well. This, if we take an ellipse, for example, and do, so one obviously fits here, as we said, there, and then, so that's one area that fits around the bell curve of the cycle. Then we've got another one there. Again, take another of these. This is actually a double fit. It fits on both sides, kind of coming up and coming out. That's like almost like perfection. And then we've got essentially this one here, which again I'm going to highlight there so you can see. So the rising price fits around the curve of this. So if you kind of add it all together, we've got 1986 kind of to 1987, about a year or two, and then you've got from 99 August to December 03. Okay, so you got like 3.5 years. Here we've got from June 14 to about April 15, so about a year. Okay, so a year, 3.5 years, a year. Okay, so let's say that between a year to 3, roughly, or a 1.5 to 3 years is what we expect the coincidence of price and the cycle to be. If we're going forward, and also like what's the space between them? So that's one wave, one where it's not really matching, another one where it's not matching, another one. This next one may not be matching. So our next kind of matching wave and price will be, you know, somewhere after 2029. That's a long time to wait. So what we have to do then is think about this harmonicity, where I showed you on the violin there, is basically the smaller waves. Now there's a sense of proportionality, so that the smaller waves need to be half the amplitude. And so if I do that, just to show you, and that will give you a sense of where we're at. So on TradingView, you've got different options. There's cycle, lines, time cycles, and the bottom one that you can't see, which is cycle wave. So I'm going to draw one of them. Okay, you can see them there. So I could actually do it in two different ways. Okay, one is the proper way, which is to basically draw them and then take them down so that every 2 troughs it coincides with the trough of the bigger wave, the mother wave or the father wave, if you want to call it that, and then the parent wave. And then basically if you take that and just modify it slightly, okay, just going to move them so that it's every 2 waves we get like that, essentially that, and squeeze it a bit more, so it needs to match every 2 troughs with the main trough, like that, essentially. Now it matches here, but it doesn't match here, for example, so it's too far out, so I have to make it a bit better. So let's do that. We'll make it, it's too wide, so it needs to be narrower. Okay, and then I shift it sideways. So there's a bit of work to do with these, and essentially once you got this through, that's kind of the worst part, if you like. And maybe I need to make it slightly wider there, because that needs to match. Now obviously the parent wave needs to be done correctly as well, otherwise this whole thing may not work. So I've got it just about right. Obviously there's a bit of correction to do, but anyway, so for this huge period I've constructed waves that are harmonized. Now the top to bottom peak to trough of the parent wave is 10 boxes, so each of these boxes is worth 5, so 120, 115, etc. So this one should be 5. 1, 2, 3, 4, and 5. Let me just check. 1, 2, 3. Yeah, that's kind of half. Okay, half the amplitude. Now, what we're going to do next is to see whether when there's a mismatch between the parent wave cycle and price, whether the second harmonic wave is actually shaping up closer to what price is doing. Also, there's a tendency for price to conform where the harmonic and the main wave come together to a trough. So these troughs, so every two troughs for the second harmonic coincide, provide a stronger pull. Okay. You can have a third harmonic, which would be half of this again. The other thing is that the amplitude of the harmonic needs to be proportional, but if market conditions dictate differently, you need to think about that perhaps being different. And the other thing that you can do is, for example, to take this and move it up, because price action at the bottom here, where we're at now, is low down, but further up here it's actually higher than the wave, so it would actually make sense to maybe move it higher, especially where we're at now. But actually what I'm interested in is that we're going to move the harmonic out of phase, so because that really respects price quite a bit more. If I do this, if I take this and shift it sideways, you will see, if I do that so that it crosses, it intersects, it kind of basically goes counter when the peaks and troughs are inverted, essentially. So when the parent wave does a trough, the second harmonic between two parent waves does the opposite. And that provides you with two kind of interactions, two true interactions. The main interaction is the parent wave, because it's quite a strong pull there, it's quite a big move there. And then the in-between is provided by the peak of the out of phase second harmonic wave. And the same within this one, which looks like a mismatch because price is not really pulling up like it did in this first wave and this third wave. The second wave is its amplitude doesn't really reflect price. Price is about halfway through that and then comes down. But if you look at the second harmonic, it actually follows the curve of that. And it does, it intersects it in 92, and it kind of follows it all the way down to 95. Basically, you know, you could have caught like a year of that, or even 2/3 of that, you've done well. Here it does the same. In between waves, it catches that intersection there, and it kind of goes up with it, and then it comes out of phase completely with everything, and then it joins the main wave, comes down, and then it joins the second harmonic there, joins the second harmonic there. Again, this is a period from 08 to 10, so about 2 years. And then you've got this situation where we are now, where essentially we've got this in-between stage that's actually not reflecting anything. So again, maybe price has moved up, so we might have to move this whole set of waves up, like we did sort of move it down here, where price had moved below this level in the kind of low 80s to low 70s. If we have gone back to the low 80s, then we have to move the whole set and the subsets up. So what does this tell us again? Which is that if you study cycle theory, you have to think about kind of periods where they fit, and then periods when they don't fit anymore, and you have to kind of redress that. So what you could do is you create 2 or 3 charts through kind of different decades, and so that you keep one set and then see when it goes out of phase, then a new set kind of moved up or down to fit new price, etc. Where we are at the moment, I think looking at this, it's kind of like cutting through and disrespecting this wave, and we're not really sure where it's going. So while this has actually fit really well in 14, 15, so it's still fairly recent, we're not really sure where this is going, so we'd have to think about a different way of drawing these, and we might have to kind of move things. If we were to kind of follow that every other wave kind of follows, rather than every 2, 1, 2, 2, etc. If this kind of followed waves in the next one, we could expect this essentially to either take the shape of the smaller waves. So it kind of followed this wave here in 2010, then this part here in 2017, that's 7 years, this part here in 2006, so 4, 7, 4 plus 7 is 11, so 5.5. So from 2017 plus 5, 22. So we come to about here. So it might be that around this time we come back down to the low 80s. I'm actually bullish the dollar, so I don't want this to happen. But I'm just saying this might happen. And if it did actually disrespect this and decide to kind of join this rise here, then you can see that the target would be like 120 all the way up. And we've not had that. But interesting, what is really interesting here is that if you look at the levels, this particular wave, if we draw some levels here, let's cut it in half, okay? Let's do a horizontal line. That's going to be 1, 2, 3, 4, 5 there. Okay, so here. Okay, so that really tells us like the halfway mark. So let's get rid of these. Cut these off. 1, 2, and 3. We'll take them out so we can see better what's happening. And now we can see that if we take these out as well, actually, because we're gonna want to have a bit more space. All right, so that's the main wave cycle, and we can say that we have from the top level here, we come down to the half level here. So this is the peak of that is 86. Then the halfway peak there is 93. That's 7 years. The full peak there, 6 plus 7. Let me get this right now. So 93. 2001. Okay, so that's 8 years. Let's call it 8 years then. Then it's actually less than half year. It's kind of like a quarter. And that's kind of around the half mark again. So the full peak comes every 6. That's actually 85. Not giving me 85. I think that should be 85. Every 8, so 16. Yeah, 2001 plus 16 is 2017. So really, to come to the full peak, we need to get up here. 2025. That's a long way away. It's 5 years. So 5 years we might expect this cycle, if it goes again, 1, 2, 3, we should be at the peak there, but we've missed it, so it might be the next one. In terms of the half marks, we've got this one here, that's in 93, okay, and then the next one is in 2017. Goodness me, right? That's 17 plus 7, 24 years. That's a long time to wait for anybody. So now we have to think that maybe this whole wave has changed, and as I said, we're going to make it a bit shorter. So that's basically what we're trying to do, is to try and match conditions to price. So instead of doing harmonics, what we could do is just do a shorter wave. So that was the full peak there, but we're not getting that anymore. We are now into kind of this. And it could be that maybe the phase is a little bit wider, so the period is a bit wider. So if we make this a wider period, I wonder. Now this is kind of like retrofitting, which is really dangerous thing to do, because you're kind of curve fitting around past price, which is never really a good thing to do. But let's just kind of test the theory there. So if we have this as a wider kind of wave, like this for example, I'm going to try and get this whole period. Obviously current price is not indicative because that might change again and it kind of ruin our beautiful predictions here. But if we make this a little bit deeper like that, and then also a little bit wider as well, just going to try and fit this whole price action, troughs as well. Okay, now we're trying to see if that whole curve fits in better with price. And I have a problem with that. I don't really think that that fits as much as the other one. So it could be that we're in an aperiodic time where price is not really. I'm probably doing this wrong, but you kind of see the difficulties in trying to match asymmetric price action to asymmetric shape. So essentially, what I'm trying to say is think of the amplitude of the moves and whether that's kind of being reduced. Try to adapt your cycle model to current conditions and think about a best fit for your actual price. And also what it tells you about price going forward. If we are fitting for the most part price here, let's do a monthly for example, probably less kind of noise. Probably should have done a monthly already, but just kind of thought I'd try the weekly first. Okay, so the monthly is a bit leaner, so maybe we get less noise and we get a cleaner kind of cycle. So that's kind of where we're at. I think this might fit a little bit better for price from around 2006, the last kind of 14 years. And if you wanted to do it, the problem is there was the market crash 2008, 2009, and that obviously is a determinant because that kind of caused price to really swing. See the dollar, that huge swing there in early 2009, kind of crashing. So that might have skewed things up a little bit. So you have to think about kind of strong events through history as well, what they did to price, and then try to really kind of model things on that. If you do the monthly, you might be able to model price a little bit better. And if you think of 1, 2, 3, 4, 1, 2, 3, 4, 5, 6, that should move probably up to, so let me see again, if that's the bottom there, 1, 2, 4, 5, that should be the half mark really. That's a bit better. So, and then think of the wave as kind of from the half mark point of view, trying to get a bigger kind of amplitude there, and then squeeze a bit more trough. If I can I? Okay, think that's kind of all I was going to say. Thank you very much for watching my video. You can see there's quite a lot of work to do still on these. I will try to get this right before I finish the video. Might not actually happen, so forgive me if I'm going on a bit. That essentially is a longer cycle, as you can see, and we seem to get more of a feel for periodicity. There's that curve there, it seems to fit better with where we're at. Obviously the half mark, it corresponds with this period between 89 and 97, the 8 years there, the full stretch there, the full stretch, and the half mark here. So we might end up, when this sort of ended, so on the other side, we had then a resumption of the fall. So it could be that after this period here, we might end up with a full resumption of the full cycle down to this sort of 72 by 2025. So in immediate, that's September, so down to November, etc. We might start seeing a move to that intent, or we could kind of move opposite. So it's really quite a crucial time to see how this fits with the phase. Thanks so much for watching. So I've been quite a while, and also really need to tell you two things, actually three. One is comment. I really want to hear from you. So if you have any questions, I really want to hear what your questions are, because that's the life and soul of a blogger, is to know what people are wanting to ask when they watch questions. Two, if you can subscribe so that I know that you're interested in more videos from me. And one as well, if you can like, so I know that you like the video. If you do like it, fair enough, I just want to hear. In the comments, also tell me, like, as well as questions. I mean, if you want to tell me, basically, like, your videos need to have content about this, I want to know about this, etc. I really like to hear from you, and I will respond to your comments, so I really appreciate it. FreeFX is a free resource. I make no money out of this, and I really do it for the love of it, because I trade for myself, and I just I want to tell people about stuff, and I learn new stuff all the time. It's not like once you know how to trade for yourself, you're happy with your results, that's it. There's always more stuff that comes your way from different sources, and now I'm doing this kind of market technician level 1 exam in December. I've got all this to learn, and I'm kind of passing on new ideas, which I'm kind of collecting like a sieve. Is really quite interesting. So thanks so much for watching. It's absolutely fantastic to be able to do this for you, and please keep watching, and tell me what you'd like to know next time. Cheers and happy trading.